Hello guys, welcome back to our channel. So today we are going to talk about um, financial crisis. Financial crisis is any of wide variety of situation in which some financial assets suddenly lose a large part of their nominal value. In the 19th and early 20th century, many financial crises were associated with banking panics, and many recessions coincided with these panics. Other situations that are often called financial crises include stock markets crashes and the bursting of other financial bubbles, currency crisis, and sovereign defaults. Uh, Financial crises directly result in a loss of paper wealth, but do not necessarily of results in significant change in the real economy. Um, Many economists have offered theories about how financial crises develop and could be prevented. There is no consensus, however, and financial crises continue to occur from time to time. Banking crisis. When a bank suffers a sudden crash of withdrawal by depositors, this is called bank run. Since banks lend out most of the cash they receive in deposits, it's difficult for them to quickly pay back all deposits if they are suddenly demanded. So it renders the bank insolvent, causing customers to lose their deposit to the extent that they are not covered by deposit insurance. An event in which bank runs are widespread is called a systematic banking crisis or banking panic. Examples of bank runs include the run on the Bank of the United States in 1931 and the run on the Northern Rock in 2007. Banking crises generally occur after periods of risky lending and resulting loan defaults. Currently rising. Currently rising, also called a developing crisis, is normally considered the part of financial crisis. Community, for instance, define currency crisis as occurring when a weighted average amounts percentage depreciations in the exchange rate and monthly percentage decline in exchange reserves exist its mean by more than three standard definitions. Frankel and Rose define a acute crisis as a nominal depreciation of a currency of least 25%, but it's also defined at least a 10% increase in the rate of depreciation. In general, a currency crisis can be defined as a situation when the participants in exchange uh, market come to recognize that a package exchange rate is about to fail, causing speculations against the bag that hosted the failure and forces a devaluation. As speculative bubbles and crashes. A speculative bubble exists in event of large, sustained overpricing of some classes of assets. One factor that frequently contributes to a bubble in the presence of buyer who purchase an asset based solely on the expectation that they can later result it's a higher price rather than calculating the income of it generate in the future. If there a bubble, there is also a risk of crash in assets prices. Market participating will go on buying only as a gold they expect from others to buy, and when many decide to sell, the price will fail. However, it's difficult to predict whenever the asset's price actually equals its fundamental value, so it's hard to detect bubbles reliably. Some economists insist that bubbles never or almost never occur. Well-known examples of bubbles or permanent bubbles and crashes in stock prices and other assets price include the 17th century Dutch tulip mania, the 18th century South Sea bubble, the Wall Street crash of 1929, the Japanese property bubble of 1980s, the crash of the United States housing bubble during 2006 to 2008. The 2000s sparked a real estate bubble where housing prices were increasing significantly as an ascent good. International financial crisis. When a country that maintains a fixed exchange rate is suddenly forced to devalue its currency due to accruing and unsustainable current account deficit, this is called currency crisis or balance of payment crisis. When a country fails to pay back its souvenir debt, this is called a souvenir default, while devaluation and default could both be voluntary decision of the government. They are often perceived to be the involuntary results of change and investor sentiments that leads to a sudden stop in a capital inflows or sudden increase in capital flight. Several currencies that formed part of the European exchange rate mechanism suffered crisis in 1992 to 93 and were forced to devalue or withdraw from the mechanism. Another round of currency crisis took place in Asia in 1997 to 98. Many Latin American countries defaulted on their debts in early 1980s. The 1998 Russian financial crisis resulted in a devaluation of the ruble and default on Russian government bonds. Wider economic crisis. Negative GDP growth lasting two or more quarters is called recession. Uh, an especially prolonged or severe recession may be called depression, while a long period of slow but not necessarily negative growth is sometimes called economic stagnation. Some economists argue that many recessions have been caused in large part by financial crisis. One more example is Great Depression, which was preceded in many countries by bank runs and stock market crashes. The submarine importance crisis and the bursting of other real estate bubbles around the world also led to the recession in the United States. A number of the countries in the late 28 and to 10, 20, and 9, some economists argue that financial crises are caused by recession instead of the other way around, and they even where financial crisis is initial stock that sets of recession other factors may be more important in prolonging the recession. In particular, Milton Friedman and Anna Schwartz argued that the initial economic decline associated with the crash of 1929, the like bank panics in the 1930s, would be not turned into the prolonged depression if it had not been reinforced by monetary policy mistaken on the part of the Federal Reserve, a position supported by Ben Bernanke. So guys, thank you for your attention. It's enough for today. Goodbye.